All right, thank you all for joining us today. This is a completely new course that we're starting to build on, and we're going to start layering in some ways to determine directionality with these swing trade setups. And my goal is to get you folks by the end of this course to a place where options just make sense. And I've geared this course specifically to introduce you folks, whether you're a newer trader or an investor that's been around for a while. I've geared this course in order to teach you guys options from basically starting out with real life concepts and building on to these option strategies that we'll be implementing in and around our portfolio. So options can be intimidating, I'm not going to lie, but like I said, I'm going to build from simple concepts to real life examples. And by the end of this, you guys should have a solid understanding of options. And my goal is to get you guys to a place where options are understood by you intuitively. And I think I can do that relatively quickly. All right, so without further ado, like I said, we're going to be talking about swing trades, figuring out directional assumptions, and then finding the optimal option strategy for that given assumption. And with this strategy, we are going to be, or this specific course, we're going to be talking about long call spreads. But first off, I want to talk about specifically the swing trades. And we, start looking at these different setups. There's all kinds of different setups. Ultimately, what I want you guys to do is when we're trying to figure out what is a swing trade, the bottom line is we have an underlying that will trade in a range, whether it kind of goes like that. We see, a resistance area, a support area. We could even see it when it's in a bullish trend or a bearish trend, right? So, we have all kinds of different ways to kind of look at these things, whether it's a sideways, vertical, or a bearish trend. What we need to do is identify the trend, see whether it's sideways, bullish, or bearish, and then find the support resistance. We got resistance, 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 support, 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 right? So we can pretty easily figure those out. And then we want to determine in this pattern, are we ready to roll back over and head up, or are we starting that downtrend within that pattern, okay? But what ultimately happens, we see this happen all the time. If we're setting up our trades, we identified the trend, we know where the support and resistance are, we get this pattern that, all right, it's breaking out or it's selling off. But a lot of times what we see happen is we will get involved in a trend that's looking like this, and all right, well, we've identified everything. We've got our resistance areas. We've got our support areas. But what happens? All right, I sell here, right? The market pops back up and starts moving like that and then maybe retraces. Or, we get a trend like this. We think that, all right, it's approaching this resistance area, and then all of a sudden it continues to go up. Or on a down line, we think that it's going to start moving higher on this trend, and it kind of falls back down. That seems to be what we usually see when we're finding these trends, trying to set them up. We might even have something like this where it gaps up and we're thinking, okay, well, we got to sell here, and then it continues higher, right? Or we buy that gap and it falls back down. So a lot of times we will see these patterns, and all of a sudden, as soon as we get in, it seems like that pattern gets broken. That's the beauty in options, to set you up. But what we're trying to do by setting up a swing trade is get the probabilities in our favor. We're trying to find out support and resistance to, turn the tables in our favor of determining what direction is going to happen next. That helps. It doesn't always work out, but it does help, because more times than not, it will continue to follow that pattern. Well, with options, when it breaks that pattern, we have layered on another added kind of area where we are safe. We have a safe zone. So if the market breaks down or doesn't go in our direction, we've limited our risk by using options in this way. So when we're setting it up in real life examples, we could say something like this. We would have identified a resistance area here or in a support level here, but what happens? We get these little breakouts on these patterns in these spots that could have caused us to get stopped out, right? Well, when you're trading with futures or you're just buying the underlying, it has an added layer of angst because you have to immediately be right. And when it breaks down, you get stopped out, and all of a sudden you see it recover, and you're just frustrated with this whole swing trade. All right. Well, with options, it allows you a little bit more time to be right because you don't always, especially with this strategy, have to have that direction move in your favor, and you have limited risk with that. So we will be able to avoid angst when the market starts breaking out with option strategies and take advantage of it when it stays within our pattern. So we can see that this underlying has a tendency to stay within a certain range there. So we want to try and find those patterns. Then we're going to start looking for option strategies. But first off, how do we swing trade? We identify the pattern, right? Identify the pattern. And that, or identify the trend. This is basically identify the trend. We're trying to identify the trend. Why? Because we want to know whether it is bullish, market neutral, or bearish. That is the overall arching trend. And then we got to spot the support and resistance. All right. So we want to find the resistance and the support levels. And then finally, we want to identify the pattern within the trend, okay? The pattern within the trend. So if it's an upward trajectory, we want to identify where we are in this said pattern, you know, whether it's we've identified the trend and now it's looking to go that way or maybe roll that way. So this is the pattern when we're talking about the pattern within the overall long-term trend here. So we want to identify the trend, find the support and resistance, or identify the support and resistance, and identify that pattern within the trend. All right. So those are the keys that we're looking for. These 3 steps. We go through that process. We find the optimal option strategy around that. Why? Because we have better probabilities. When we do this, we have good probabilities when we've identified that pattern. We're staying within that. We know that there is a likelihood this market is going to start correcting or continuing in this pattern. But what we want to do is have better probabilities of success. All right. Options will give us better probabilities in that overall trade. So what we want to do, we identify the trend. In this case, we would say that the trend is sideways for IBM. We found the support and resistances. We would say that basically, I would say that Fibonacci and this Fibonacci are the support and the resistance and the support levels, right? Now we identify the trend within that, or support and resistance. Now we identify the pattern. So we've got the pattern. We've got our highs, lows, highs, lows, highs, lows, and we're at a high. It looks like we're ready to start rolling over. So now we are trying to identify the pattern. The pattern looks like it is downward here, right? So that's what we're trying to do when we're setting up those earnings trades. We can do it with all kinds of them, like with the SPY. We have a bullish overall trend. We have this resistances along the lines here. We have resistances, we have supports. We could even look at maybe the 50-day simple moving averages as supports, right? There's a lot of different ways to find support and resistance. You could have Fibonacci's where you have the fibs, right, lined up. I use all of the different drawings and things that you guys might use as well. Try to simplify it down to a few things that I've found to be real key indicators. Most of them is the trend channels. Fibonacci's I like as well, and the 50-day simple moving average is another key one, especially for short-term trades as well, or swing trades, not day trades, swing trades. And so we could identify this, and we could identify the pattern within the trend and say that, you know, that might be a key place to where we're finding support on that 50-day simple moving average. Now, the beauty in this is a lot of times when you're doing swing trades, you're kind of waiting for that market to come down and hit a specific spot. Well, the beauty in options is we can allow ourselves that little bit of leeway. We can pick those locations using our option strikes without it ever even coming to that level. And then ultimately, what I want to look at today is, let's take a look at Intel. We have a bullish trend. We have support and resistances we can find. We see that it's finding a support right here on this Fibonacci, right? So it hasn't been confirmed yet, right? But I'm expecting this market to start taking a bit of a move to the upside. And I've identified the pattern within this, and I think it's going to start moving back higher, right? So we've gotten our trend, we've gotten our support and resistances, and now we're figuring out the pattern. The pattern looks like it's starting to revert back towards a bullish trend there. So with that being said, I would look to implement a strategy around a bullish assumption, right? Well, with options, folks, we need to talk about this. Options, the call buyer has the right but not the obligation to buy the stock. So if you have the right but not the obligation to buy the stock, you are bullish. You expect this underlying to go higher. A put buyer has the right but not the obligation to sell the stock. So if you buy a put, that is the area you would be willing to sell it, all right? So if we're looking at a bullish move, long calls help us on a bullish move, right? Long puts help us on a bearish move. Now, on the flip of all of that, if you are selling a call, folks, that means you are willing to deliver your stock, or you're willing to sell your stock at that level, all right? And if you are a seller of puts, that means you would be willing to buy that underlying at that level, all right? So bullish options are buying calls for a bullish move or selling puts for a bullish move. You could use either one of those interchangeably in order to benefit, or in order to profit from a bullish move, right? Now we really have to dig into these and determine which option is best for a bullish move. Is it buying a call or selling the put? Well, we have to actually figure out a couple of things with that. You know, I like to know if I'm buying something cheap or if I'm buying something that's really expensive, right? So we need to know that with these options pricing. We need to know if they are cheap or expensive. How do you figure that out? Well, volatility is going to tell us that. And really, volatility is this little thing over here called Vega. All right. And what happens is, as this number increases, our premiums increase. This just gives us a gauge as to how much they are going to increase, folks. And what we can see is that if it increased by 1% on this Vega, which is just implied volatility, all right? Implied volatility. If it increases by 1%, our premiums will increase by that corresponding number in all of the options. Calls, or on the put side, which is the puts, or even on the call side, when we're looking at this volatility, it would increase those premiums by the corresponding amount. Now, something to note, you can see that volatility affects the further duration. These options that are further away more. You can see that this number slightly incrementally increases the further time we have, or the more amount of time we have. So volatility will affect those further options more. Just know that. Put that in the back of your head. Kind of squirrel that away for a moment, that these options further out in time will be affected by volatility more, all right? So volatility determines whether or not these premiums are expensive or cheap. Yes, you can see that they are more expensive for the same strike further out in time than the ones that are near out in time. That's not what I'm talking about. That is, you're paying for more time to be right. You know, that's why those options are more expensive. You've got more time to be right. You got to pay for that. But what I'm talking about, at any given moment, if the options fluctuate in price, that is mostly due to that volatility coefficient. And it's really going to affect the premiums, whether they are expensive or cheap. That's going to be the determining factor. We can't just look at this number and say, all right, well, 32 is high, 37 is, you know, even higher. That's not what we're talking about. I need to know where this number is in relation to where it's been in the past for this underlying. And I'm not talking about VIX. I'm talking about this Vega implied volatility number right now tells us what our premiums are, but it also doesn't tell, it will indicate whether or not they're expensive or cheap once we start really digging into the details of this. So what we're talking about with volatility is this. Remember, I said implied volatility. Well, if we throw it on a chart, you know, it's the same thing as like a swing trade. You find your resistances, your supports, and those are usually the extremes. Yes, it will slightly break out of those ranges every once in a while, but at the end of the day, what we can tell is when it's at the upper band, that those premiums are expensive. Why? Because volatility for this underlying is experiencing the highest volatility it's seen in a while. Well, when volatility is extremely high, we automatically know those premiums are very expensive. And when volatility is really low, it means that those premiums really only have time decay left in them. All right. So that is a component that will erode, but those premiums are cheap in relation to where we have seen them in the past. Does that make sense for everybody? And please feel free to jump in there into the questions box. If you have any questions, not clear a concept, please throw them in the questions box because I'll answer them as we go along here. So this number right here where we are currently will tell us that, you know, we're kind of closer to the lower band here than we are to this upper band, right? So we can tell that maybe they're not super cheap, but they're relatively cheap. And we can even drill down on this even more by going into this chart and drawing some lines, just like you would with a trend, right? If we're looking at a swing trade, we can see that we find support down here at around, let's just call it 28, all right? And we find some resistance up here at around, let's call it 47 to the upside. And we can see that we're currently trading right around 35, right? That's this number here. I just threw this in there because this is about 50% is kind of where I'm guesstimating being right in the middle of the road. So the idea is we buy when it's below that 50% line and we sell when it's above that 50% line. We're buying options when it's below and we're selling options when it's above, right? Because we're buying options when they're cheap and we're selling options when they're expensive is really what that comes down to. Now, if you really want to dig into this, how we come up with this number and stuff like that, it's called the implied volatility percent. You can get this in the option montage for like the trading platforms, and I have script to throw over into Thinkorswim's watch list. You can reach out to us to get that. But if you want to figure it out, because we have some extremes, if you ever want to get rid of an anomaly like we saw back in the pandemic, the height of the pandemic, I don't think we're going to see that kind of volatility anymore. So I think that we need to take that out of our data set, if you will. So what we want to do is we want to take where the current is, current implied volatility, minus the low implied volatility, and we take that sum and we would divide it by the high implied volatility minus the low implied volatility, okay? So we've got all these numbers. We've got the current, which is 35, minus the low, which we said was 28. And we divide that by the high, 47 minus 28, right? So basically we are looking at 7 divided by 19, which is basically going to give us 36 or 37%, 36.8%. All right. So my rule is below 50% we want to buy and above 50% we want to sell. So we would be looking to buy option strategies because we know we're getting them relatively cheap. So that is anytime it's greater than 50%, we sell. And when it's less than 50%, we are looking to buy, right? Because that's when we know they are getting cheap. So in this case, we think that those prices are going to be cheap, so we want to buy options. And if we're going to look to spot the right option strategy, These are the processes we're going to go through. We look at where that implied volatility is for that specific underlying and determine if those premiums are cheap or expensive. That's step number one in determining, spotting the right option strategy, is trying to figure out if we're going to buy options or sell options. In this case, we've determined that implied volatility is cheap. Our premiums are not very expensive, so therefore that would lead us towards buying those options. Now, if we are buying something, we have to be good stewards of our capital, right? You don't want to just throw money away. And one thing with options is there's this little guy who's called the thief in the night that comes and steals your premium. And that dude is theta. Now, we do need to talk about these Greeks. We talked about Vega. Pretty simple, right? A lot of people try and make Vega very complex. It's simple. It is used to determine our options pricing, all right? It will tell us if those prices are cheap or expensive. We determine they're cheap. That leads us towards buying options premium. Now, if we are buying something, we have to be good stewards of our capital. We have to limit that theta thief in the night that comes and steals our premium. So we can see that theta it's time decay, folks. All right, so you may have heard it called time decay. Theta is the thief in my eyes. It is time decay. It comes in and starts picking away at your premiums. But it's not linear, meaning it's not every day finite exactly the same amount of money. It's not consistent. Inside of basically 35 days to expiration, for the next 25 days, you get a 50% drop in those premiums here. Okay, so if you're buying something and you know in 28 days it's going to be worth half, all else being equal, the underlying doesn't move, nothing else happens. All you do is watch your premiums erode by 50% in 28 days. Now, you can see the further out in time you get, this theta is a lot less aggressive. So if you're buying, basically you want to be somewhere outside of 70 days to expiration if you are a buyer. All right. This is the sell zone inside of 35 days, or right around 35 days to expiration. All right. So we've already determined prices are cheap, right? We also want to limit that theta decay, which means we need to get out in time. All right. This is all setting up, going through your process when you guys are trying to determine an option strategy, folks. These are your steps. First thing to do is determine whether or not those options prices are cheap or expensive, all right? We've determined in this case, they're pretty cheap. If they are cheap, I need to limit that theta decay and get out in time. My sweet spot is outside of 70 days to expiration. Right now, it's going to be landing right around 80 some odd days to expiration. And we can see this really show up when we look at the option montage. When I'm talking about the option montage, folks, what I'm talking about is the screen that has all the strikes, all of the options, all of the different expiration cycles. But we can see with just SPY as an example, I took this screenshot today, a little bit earlier than the end of the day. But we can see that theta inside of that 35 days to expiration. We're inside that closer to 35 days to expiration. Look how aggressive theta is. It's 12 cents every single night. Well, outside of 50, it is about 8 cents a night. And outside of that 70 some odd days that I was talking about, it's only 7 cents a night. Now you might be saying, hey, 7 cents, who cares about 7 cents, Wolfman? Who cares about 12 cents? Well, remember, every one option contract is equivalent to 100 of the underlying. That is the option contract multiplier. So when we're looking at the pricing and everything else, we have to remember to multiply that by 100 every single time because of that option contract multiplier. So if $12 a night doesn't mean anything to you, or we could even say $4 extra, right? Because if you got involved in this option strategy about this 58 days to expiration, you can see inside of 58 days to expiration that theta has really ramped up every single night. So, if $1 doesn't mean anything to you every single night, you can probably ship it off to somebody, I don't know, maybe a friend or somebody who teaches you guys how to trade options or something. But inside of outside here at 86 days, Look at that. The same amount of time, basically, we would have only over the course of that time rallied up to an extra $1 a night. All right. So a lot less aggressive will help us turn the tables of probabilities in our favor if you can limit that theta decay when you have bought an option, right? Does that make sense, everybody? You can see that if I was involved, if I got involved in the June and those 20 some days went by, almost 30 days went by, I only lost one extra $1 a night to theta, whereas in these next, 20 or 30 days, it has almost doubled. Okay. Not quite, but it is a massive difference between those two. And that will, you have to make up for that in directional moves. We don't want to have to do that. We want to try and limit our risks. And one of the ways to limit our risks for this trade, if we're buying something, is to limit the thief. Because that thief really is a risk to our profitability, right? So we need to be very aware of that. All right. So we've got this so far, right? We've determined we have to come up with our swing trade. We first come up with a trend, find our support and resistances, and then within that trend, what is the pattern? Is the pattern starting to revert back to a bull move, or are we going to have a little bit of a correction there? So we need to determine those things first. Now we determine we've got our pattern. We know we're either bullish, bearish, or market neutral. In this case, with Intel, I'm looking at a bullish move. A bullish pattern inside an overall long-term bullish trend. All right. So I'm looking to then see my premiums. How expensive or cheap are they? Well, I've determined they're pretty cheap. So I'm looking to buy them. I want to limit that theta decay. So I'm going out in time. Well, what do? We want to get involved in that long call spread. Another reason why I want to get involved in a long call spread versus just a long call for that bullish assumption. I would never sell the short put, right, for that bullish assumption because those premiums are way too cheap. I don't want to sell something cheap. I want to buy something cheap. So that's what automatically flips us over to the call side. Now, the reason why I'm leaning towards a long call spread is because I want to limit my risk a little bit. You guys know that in this trend with this underlying that I found, it does have a good support and resistance, but I also want to limit some of my risk in case I go wrong. So I'm trying to lower that overall premium that I paid for it. All right. If I was full on bullish, great, maybe even a confirmation on this trade or on the swing trade, well, then maybe I'd be a little bit more aggressive and go to the call, but it hasn't gotten confirmed right yet. So I'm going to try and limit my risk just a little bit on this trade, which is why I'm going with the call spread. All right. And when we're looking at the call spread, I know you guys want your calls. You guys want the strikes already, right? Well, we have to look at the standard deviation. We are looking at our probabilities. And what I want to do, if we are looking at an in-the-money option, which I'm going to give you guys two, if we're looking for an in-the-money call, this is about an 84 delta, all right? And then we would sell somewhere up here at around the 16-ish delta. Ultimately, what I want to do is pay for all of the extrinsic value of this option. So I own that strike for the true face value of it. I'll talk about that here in a little bit. But I want to try and pick the 84 delta. Now, you guys might be going, Wolfman, delta, you're talking like standard deviations and everything else. Delta is the rate of change to an options premium. Yes, it is. But what I want you guys to come away from this is delta is data, all right? And more importantly, delta tells us the probability. Again, we're going back to the probability, right? Probability of being in the money or in the money, all right? So delta, more importantly than even how it's affecting our options premium in this case, is our probabilities. That's what we want to look at. Delta will tell us all kinds of information. One of those is probability, and that's really what I want you guys to drill down on. So ultimately, what are we going to do? The long call spread. Now you'll notice I say in the money and at the money. There's two different strikes that we could use. If you're looking at the in the money option, if you're going to go in the money, we're looking at the 84 delta to buy a call. And then we're going to sell it around a 16-ish delta call. It might even be a little bit closer than that. If we're doing the at the monies, we're going to go, if we're going to go at the money ones, then we're looking at about a 50 delta. Now this one, we're going to risk one to make one. Risk one to make one. All right, over here. This one, we want, if we're going to do the 50 delta, we want to risk one to make two. All right, or you're paying about a third the width of the spread there. All right, this one is just, you know, whatever you're paying, you're risking one to make one. So if we're going to go look at this Intel trade, right? We've already determined we've got. Let me try and pull up a platform here, see if I can get my Intel up here. All right, so with this being said, we can see we've got a bullish upward trend. I can see within that where my support and resistances are, this obviously I think is a support. I have not gotten a confirmation to the upside. That's why I'm starting to lean towards this call spread, limit my risk a little bit to the down. Remember, when you buy a call, when you're a buyer of a call, you have the right but not the obligation to buy that underlying. So if the underlying starts trading lower than where your call is, are you going to want to buy it higher? No. You've limited your risk, that you have no more risk below where that short or where that long call is. So if the underlying falls down, you have no more risk. Whereas if you went out there and did the swing trade with using the regular stock and you bought it on that bounce or where you thought that bounce was, you got like a stop down there that you're worried about that it's going to get you out of this trade. Well, with options, it allows you to keep your powder dry, folks. It allows you to stay in this trade longer because your stop is already embedded in that long call, right? If I don't want to exercise my right, or there is no face value, there's no value to this stock, then I'm out. That's really a synthetic stop embedded in this call. If the underlying goes down, I don't have to worry about this strategy anymore. All right. So it allows you to stay in this trade longer rather than just getting stopped out every time the algos start pumping this below a support and resistance level. And believe me, they know where those levels are. They know where the pain points of most people are. The beauty in options is you don't have that same feeling. You don't have that same angst, which is what I'm trying to, that's why I've switched over to trading options exclusively. I just did a guest spot not too long ago, and I was talking about, I'm basically a recovering futures trader. I'd rather stick with the options, and that allows you to stay in these trades, keep your wits about you when things aren't working in your favor because you know you have limited risk in this specific trade. So let's talk about the strikes. Let's talk about the at the monies first. Now, what I was talking about, 50 delta, that's what I'm looking for specifically for the one that I'm buying. It's the one that's going to be closest to the at the money. Sometimes it will be slightly in the money, but more times than not, it's going to just be slightly out of the money or at the money. So I would look to buy the 62.5s and then sell the 70s. Now, here's another little quick hit for you, is when you're dealing with an underlying, if it's around a $50 to $100 stock, you're going to be looking at about $5 to $10 wide on these spreads. So basically kind of shoot for about 10% to get you guys your wheelhouse on where you need to make these spreads. So a $200 stock, how wide are my wings going to be, or how wide is the spread going to be? $20, right? $300 stock, about 10% of that is $30. So when you're looking at your underlying, I got a $325 stock, well, it's going to probably be right around $30 wide on these spreads that are just out of the money, okay? So you can see here, just slightly less than a third the width, but 27%. So right around that 33% the width of the spread. I want to risk one to make two. That's 33%-ish. In this case, I'm risking one to make almost three. But $10 wide, got my call spread, risk one to at least make two, all right? That's the bottom threshold. You don't want to risk one to make one on an option strategy where we're doing the at the money calls, right? At the money and then the out of the money, right? And then if we were going to go and flip to look at one that is going to be one of these in the money options, still look, I'm still going outside that 70 plus days. I got that lower implied volatility, right? Means my premiums are cheap. I'm going to try and limit that. If I know my premiums are cheap, it leans toward buying, right? And if I'm buying something, I want to be a good custodian of capital, which means I need to limit that thief. I need to kind of keep the doors locked and take advantage of that. Now, if I'm going for that one that is in the money, you can see I went for that 84 delta, right? That's the 52.5 calls. And then went to the 72.5 covered. Now, one of the things I want you to know, when you're going with this in the money option, I want to pay off all of the extrinsic value I said earlier on, right? What is extrinsic value? Extrinsic value is all time decay, all right? So what I want to do is look at the corresponding put and see that there's about 90, this is a little trader hack for you. The corresponding put gives you a really good idea as to what the extrinsic value of my in the money option is. So I'm going to say it's right around 90 some odd cents. That's what made me go out there to look to sell this strike. I'm trying to pay for all that extrinsic value. That means I have bought this option strike for face value, meaning the in the money options have to include the benefit, meaning that has to be equivalent to my strike plus what the underlying is currently trading. We can see that this difference between 52 and 62 is $9.50. Well, if I take this dollar out of here, you can see I'm right there at around that $9.50-ish cents, okay? So my strike that I'm buying it for basically face value. Does that make sense? So I've gotten rid of all of that time component. I don't have to worry. I've isolated theta, all right? So I own it for what it's worth. And I have no risk below 52.5, all right? So if the underlying starts selling off, I have no risk below that level, all right? So I've limited my risk, and on this one here, where we were using the 62.5 calls, right? I have no risk below where that strike is. So if the underlying takes a dive, this is my complete risk. If I went out there and bought Intel, bought 100 Intel, my risk is to zero. I have to worry about that stop. What if you wake up tomorrow and you got that trailing stop that you have, but it opens up and a gap's lower? Your stop is executing on that gap lower. Well, when you have options, the beauty in it is we don't have to worry about that stop execution, risk, because I am the one that can say even after the close that I want to exercise my right. All right. So with that said, this is a much more suitable strategy for a swing trade than it would be with the other one. And we've limited our risk on this. All right. We've limited our risk to the downside. Yeah, well, with the spread, we've kind of capped it off. But look, when I'm looking at the 72.5 strike, right, that you guys might be saying, yeah, you limited your risk there. Well, when I pull up the chart, we'll see that 72.5 strike is quite a bit higher. So, those are rich problems to have. If I get this rally and this market pops higher up to my 72.5, I'll be happy, because that's basically going to be very close to that upward trend line, right? So let's review a little bit. Forget about the swing trade. We've already determined those are pretty simple to figure out, right? In my daily market commentaries, you guys, when I'm talking about every single day, I talk about these types of setups more than I have time to do in these webinars. So make sure you please check those out, the daily market commentaries. Do those every single day for you folks. Talk about all my trades, when, where, and why I'm putting those on. And I talk about setups a little bit more in those videos than I do have justice for in these webinars, where I'm really trying to specifically drill down on the option strategy and why we would implement those. So with this, again, we still got that bullish move. I just need to determine whether or not I am picking the one that is just at the money here, or if we're going to be looking at the one that is in the money at that 84 delta. Risking one, right? We got $20 wide. I'm risking one, $10 to make $10, and the other one, I'm risking one to make at least two, right? Those are the two rules we're looking for. Another thing we also want to make sure when you guys are trading options, I know you can find a swing trade on just about any underlying out there, right? But what I have also for options is something to keep you guys from getting involved in options that have these really wide bid asks. So on an underlying, if it is trading less than $100, all right, then we need to have our bid offer in the option montage to be less than or equal to 10 cents, all right? And this is in the spot month. So when we're looking at this specific strategy, if I were to go to pull up, let me see, I want to get to the one where I have, give me a second here, sorry. I thought I had a option montage ready to go, and I don't, because that one is too far out. So, all right, so we got a stock that's, for stock that's greater than $100 or less than $100, we already talked about, it needs to be less than or equal to 10 cents wide. On a stock that's greater than $100, we need to move the decimal 1, 2, 3 points to the left. So we can see us trading 387. I go 1, 2, 3, so that's basically 38 cents. So I need to look down to the option montage and make sure that these are within 38 cents to the bid offer. And you can see that for a stock like SPY or an ETF like SPY, it fits that rule. Make sure it will fit that rule for like an IBM and those type of underlines. And if it fits that rule, we want to make sure it is less than or equal to 38 cents. All right, that's your green light. Stock less than $100, make sure it fits that rule. On the bid offer, on the options that are closest to that 35 days, that sweet spot, that's the spot month. So if we were looking at Intel, let me just pull up a platform. Let me go like Intel. So we pull this option over, go to the ones that are closest to 35 days to expiration, and we can see that this is 6 cents wide even after the close. Make sure you're checking these during open market operations, because after the close, these markets can get really wide. So you can see that this is fitting that rule, less than or equal to 10 cents wide from the bid offer on the options that are closest to the underlying. Can you put up your exit strategy slide? Yes, I'm getting ready to do that. Give me 1 second. So, as JQ knows the pattern here, how do we get out? When do we get out? When our short strike, our short call is touched. All right, when our short call is touched. So in ours, we were looking at the, what was it, the 52.5, 72.5, right? That was the in the money. So when this strike gets hit, that's where I'm covering this, all right? You could also, I also would say that once my premiums have increased by that in the money one, once those premiums have increased by 50%, that's another exit that I'm looking for on that, especially that one that's in the money. But once that short call is breached, that's when I'm looking to get out, all right, on a win. On a bearish move, this breaks down below where my setup is, that's where I'm exiting. Just like on a swing trade, folks. If you had a swing trade where, you know, you've got the market, you've seen it sell off, and then all of a sudden you've got this candle, and that is your signal. All right, it looks like we're going to start moving to the upside. That is our entry, right? Where would your stop be? Right here, somewhere below that wick, right? Well, that would be where I would exit my swing trade in this as well. So those swing trades are still going to be in effect. Now, That is if you are really new to options trades. With me, I am going to let this thing ride out, right? I'm playing the probabilities out because I've set myself up for a good move. I've got this swing trade. I've also limited my risk. I know that the algos are sometimes going to try and push this down there, get people stopped out before that happens, right? Anymore. I know that these patterns can get broken relatively quickly. So this allows me to get in and stay in, keep my powder dry. Does that answer your question, JQ? I'm looking to go, if my short call gets touched, that's where I'm getting out. I'm immediately getting out of this trade. If we start seeing volatility really explode, well, and the underlying's not moving, well, then that might be an opportunity to say, all right, well, 50% increase in my underlying, it hasn't gone anywhere. I'm going to look to get out as well. Or some of you newer options traders. Does that make sense? 50% increase. Do you have a slide that shows the percent, shows how long in the trade? No, because we're playing this for a swing trade. Sometimes swing trades will take, a swing trade really is defined as basically longer than 2 days because a day trade is intraday, right? So a swing trade is trying 2 to basically 6 months out really is a swing trade really. So how long are we going to be in this trade? That is never something I can define definitively. So what I would say though, if that short call gets touched, you've beaten the probabilities. That's why you want to get out. Plus you can't do you're not going to make that much more with this underlying continuing to rally. You're just increasing your risk of having to, all these assignments going on. Because your short call, yeah, that can be called away from you, right? Well, I also have a long call that I can offset that strategy from, but I just don't want to deal with that. So as soon as that short call is breached, I'm covering this strategy. It may not be the full width of the spread that I'm able to cover this for. It might be a little bit less than that. I'm willing to get out while the getting's good, all right? So get out as soon as that short call is breached, all right? Does that make sense? All right. Anybody else have any questions before we start moving on? You going to Jared Jackson in Scottsdale? I don't plan on it, but I haven't ever planned on it, and I've gone like 3 times since I've lived here for 5 years. I do love that show. They didn't have it last year though. I don't know if I'm going to go. I would love to go and buy a car from there one day. I've just never gotten around to it soon enough. Wednesdays are the day to go to Barrett Jackson and get good deals. All right, folks, without any more questions, this is going to be your offer I'm going to give you guys. We have the Options Lab for $97 a month. You guys, you have full access to me. So you have a mentor in your back pocket where if you have any questions, comments, or anything else, I'm going to be sure to reach out to you. Make sure that you guys, even if I have to call you folks. Also, you get my daily market commentaries. Those are where I talk about all my options trades, folks, and when, where, and why I'm setting those up based on these swing trades that I'm going to be finding. So it's not always going to be like today where I found the swing trade in Intel and setting it up tomorrow. I'm going to be setting up some of these strategies when I find them throughout this new course. And we'll talk about those examples in the webinars, but you'll get the real life nitty gritty in these daily market commentaries. So I'm not cherry picking trades, folks. I'm talking about all my trades and staying accountable. All right. Also, you get Options Lab question and answer office hours. Like I said, you can reach out to me, and VIP to all of our guest spots and everything else that I'm going to be doing. All right. So you get first access to that. $97 a month. You guys cannot beat that. If you guys want a mentor, I'm your man. And like I said, I build from simple concepts to real life examples and all of these things. And finally, I want to thank you guys all. Later webinars, I'll drill down on different option components when and where I find them. Again, here is that link. I've thrown it over there in the chat window and sent it out to the entire audience. So you can easily just click on that link over there in the chat window. We've been going back and forth in the question box, not to confuse you guys. Got to hit that link over there in the chat window because I can't send a hot link over there in the questions box. All right, finally, take a moment to go over our disclaimer. We're an options company for education. I'm not trying to give you guys strategies to implement in your, or I'm not trying to give you trades recommendations. What I'm trying to do is help you guys come up with your own directional moves, find the option strategies that's best suited for you. In that, we will all be in harmony. All right, here's that link again. Make sure you guys check that out. If you have any other questions, comments, or anything else you want to reach out to us, you can get me at trading@protraderstrategies.com. All right. So love to hear from you. Also, if you like the video, give me a thumbs up. It really does help. I do appreciate it. And again, questions, comments, anything else in the bottom, I'll make sure that I respond to you guys, make sure everybody's clear of concept. All right. That's all I got for you guys. Have a good one. And ultimately, you got your cameras up. If you can't take that, take it easy. Take care. Great show. Like the changes. Appreciate that. Take it easy, JQ. Have a good one. Bye for now, folks.